Hi, my name is Maria Baeza and I'm a financial agent. I'm here to share with you some rules that will help you in the money game. Let's take a look. First of all, let me share with you who I am and what I do. I've been in financial services for 2.5 years, have had the pleasure of working with families across the country, and many things have changed in the way I understand finances. About 20 years ago, a company out of the Netherlands called Aegon decided that they were going to branch out and do services, provide services here in the US. They had already successfully established themselves in Europe. They've been around for about 100 years. And because they were one of those companies that are considered too big to fail, they decided that they would purchase two companies, Transamerica, also a giant in financial services, and WFG as an administrations and operations platform. We have grown tremendously. We're now in all 50 states, Canada, and Puerto Rico. So we're able to support agents, grow agents, develop agents, and help families across the country. So let's talk a little bit about choice and the power of choice. As an agent, I'm a non-captive agent. What that means is that I'm able to work with different companies and provide a number of different services. In terms of the services we provide, these are the most popular. So you'll see anything from a 401k, right? Rollovers, life insurances of different types, long-term care, college plans, index universal life, fixed indexed annuities, executive bonus plans, legacy planning, wills, living trust, and many more. What I want you to do is to take notes as I share with you this information, because I'm sure there'll be things you'll want to talk to me about later. But for now, let's just take note of what you do have currently. What kind of services, plans, and protection do you currently have in terms of finance? And what would you like to learn more about? The other area where we have lots of choice are the companies that we work with. So as I mentioned a second ago, I am a non-captive agent. What that means is that I represent the client. I am not representing a single company. So these are just a handful of the most popular companies that we work with. In fact, we are able to work with anywhere from 70 to 100 different companies on any given year. They have to all be rated A and above, and we are able to then select products and services that best meet the needs of our clients, which is wonderful. Okay, let's talk a little bit about some rules of money. There are 3 rules that I'll share with you today. The first one is the rule of 72, which describes compound interest. Compound interest is the ability of money to double itself over time. So it's very different to simple interest and works in your favor because it moves your money and it grows your money much faster. So compound interest works like this. We're going to take the example of a 29-year-old that has $10,000, and we're going to compare 4 different types of savings accounts. The first one is an account that gives you 1% interest. The reason it's called the rule of 72 is that 72 is the magic number. And this rule was actually discovered by Albert Einstein. He was able to, he was a genius in terms of patterns and science and numbers. And so it's no surprise here. But if we take the number 72 and we divide it by the interest you receive on an account, you'll be able to determine how many years it'll take for that money to double itself. So if we take 72 divided by 1%, it tells us that every 72 years that money will double. So if you're 29, have $10,000 in that account, 72 years after that, at 101, you'll have $20,000. If you find an account that gives you 4% interest, 72 divided by 4 is 18. Every 18 years, your money is going to double, and at 65, you'll be looking at $40,000. If you have an account that gives you 6% interest, now 72 divided by 6 is 12. Every 12 years, your money will double. And at 65, you would have $80,000. You'll see here that from 4% to 6% at 65, you'd have double the amount of money, even if the interest difference has not doubled. Right? We went from 4 to 6. Let's see what happens when we do double the interest. Now we're going from 6% to 12%. 72 divided by 12 is 6 years. Every 6 years, your money will double. Now at the age of 65, you would be looking at $640,000. Obviously, you could ask a child and they would tell you, I want the bigger number, I want the green one, right? That's obvious. Everybody's looking for high yield interest accounts. Do we understand though that we have to also look for interest accounts that give us, or accounts that give us compound interest? That's very important. The next rule we'll talk about is how money grows. This is really important as well, right? We have money, we put it away, and now what happens, right? We can have 12% in an account, and they do exist, by the way, but let's say we have 10% interest. But where is that interest? Where's that money invested? Are we looking at a fixed account, a variable, or an indexed account? So we have three different types of investments. A fixed account is what you would find in an account such as a savings account or a CD, where you know how much interest you are receiving from day one, and as long as your money is in that account, the interest will be the same. A variable account is money that is invested in the market. So when the market does well, your money will grow. When the market does poorly or there's any drop, you'll lose money. So you'll make money, lose money for the life of the account. An indexed account is a hybrid of the two, and I wouldn't be surprised if you'd never heard of it, because this is one that often makes people, wake up in the presentation. They realize this is something they haven't heard. But an indexed account is a hybrid of the two because it mirrors what is happening in the market. And whenever there's growth in the market, the money in an indexed account will grow in value. But whenever there's a drop, the interest will stop at 0%, so that you have what we call a floor, where you have that protection. So how would you like your money to grow? In a fixed, variable, or indexed account? Write that down. The last rule of money is how money gets taxed. And we have, again, three different types of tax systems. We have tax now accounts, and these are accounts as you see here: savings accounts in a bank CD, brokerage account, and mutual funds. These accounts are going to take your investment, your money, every month or every quarter, whatever you design. And this is money that has already paid taxes. So let's take an example of somebody who makes $5,000 gross, right? So that's how much you make, and you take home $3,000. That's your net income. That's how much you take home. Out of the $3,000, you decide to, let's say, put in $100 a month into a savings account. Every month you invest that money, every month you save that money, and at the end of the year you'll get a statement from the bank saying, thank you, you made $1.52 in interest. Please report that to the IRS and pay taxes on it. So we call that tax now because not only are you paying taxes on the money before you put it into this type of account, but you also have to pay taxes every year on anything that was earned. Tax later accounts are a little different. You will invest money into these accounts before you pay taxes on your gross income. So let's say, again, you're making $5,000. Out of the $5,000, you'll invest some money, right? We're looking at 401k plans, which are plans, pension plans that are through private companies. We have 403b plans, which are for public employees, such as firefighters, often healthcare workers, teachers, police officers, anybody who works for the state and for the city, right? So anybody who is a public employee will have a 403b. IRAs and SIP IRAs, annuities and pension plans. These are plans that are generally offered to us through work. These are all plans that will have you contribute before you pay taxes on your income. Great, sounds wonderful. Generally, they'll come with a match from your employee. Great, free money, that's what we're told. What they don't tell us, though, is that that money will be taxed. You will be taxed on all that money once you retire. So whatever you put in, what your employer puts in, all the interest that is earned is up to you to pay. Your responsibility. These plans often come with a rule called the 59.5 rule, which means that you are not allowed to touch that without paying penalties if you touch it before 59.5. Generally, it's a 10% penalty. So what happens is that you're leaving that money there, and guess who benefits the most out of that? It is the IRS, because that money's been sitting there growing, right? They don't guarantee that your tax rates are going to be the same when you retire. And so what happens is that you take the risk. You take the risk in terms of how much you're going to pay on taxes, what the tax rates will be in the future, and there are a few other risks that we can talk about when we meet. Tax advantage plans, on the other hand, are a very interesting concept. They've been around for about 100 years. Some of you may recognize some of these. So these are plans such as municipal bonds, Roth IRAs, executive bonus plans, and cash accumulation in an insurance policy, also known as life insurance retirement plan. These are plans where your contribution is made after you pay taxes on your income. So let's go back to the $5,000, $3,000 example. You make $5,000, you keep $3,000. Out of the $3,000, you invest $100, right? At the end of the year, you're not paying taxes on the growth. In fact, that money is growing tax-free. It is your money, and you don't have to worry about paying taxes. So as you can imagine, this is what the wealthy are doing with their money. This is how the wealthy are saving for their future. And this is how companies are saving their assets. So it's everybody's using this, and you should too, but you need to know about these. Let's take a look at the 3 rules of money now, just quickly. I want to always capture quickly what we just covered. So the first rule we looked at is the rule of 72. It describes the accumulation phase, right? We want to accumulate our money efficiently. We want to make sure that our money is accumulating and growing as much as we can. Rule number 2 is how money grows. It describes the protection phase. Is your money so protected that it's not growing? Is it not protected at all? Or is it protected and growing? And the last rule of money is how money gets taxed. We have 3 different types of tax systems, and we want to make sure that when it comes to the distribution of your money, when it is your time to receive your money, you are receiving as much as possible and that you're not being taxed more than you should. I love this quote, and I use this quote. I try to live by this quote every single day because I wasn't always good at doing this. But Warren Buffett, who obviously is one of the wealthiest men in the world, has been one of the wealthiest men in the world for a long time, will say to you, and I would agree, do not save what is left after spending, but spend what is left after saving. So save money, put away money, and then budget the rest. Do not wait to have leftover money at the end of the month and then put that away, because that will never come. I'm going to leave you with this today. We offer 6 different services. I offer 6 different services, and you'll see this here. We call this the financial needs analysis. We want to make sure that we're helping you analyze your financial situation and that you're able to set some goals. And there are 6 services that we provide. The first one is to increase cash flow. So we help you manage your expenses and look at your budget. Is there anything that you could be doing differently so that you can save more of your money? We also help you if you're interested in a career in finance, right? So you can earn additional income. We also support families who have kids and who are thinking ahead and are planning for college. We offer emergency fund planning so that you're putting away money so you have enough for 3 to 6 months of income in case of an emergency. We also offer proper protection. What does that mean? We're talking about financial protection, right? So making sure that we're protecting you, we're protecting your assets, we're protecting your income. We are helping families build wealth. That would be the 5th option. Making sure that you are outpacing inflation. This is a huge topic right now. And that you're reducing taxes, right? You get a professional money manager, somebody who works with you, who supports you, who helps you make decisions, doesn't make decisions for you, but helps you make the decisions. And then we also offer the ability to preserve your wealth, making sure that you're leaving a legacy and not a liability to your family members. And again, reducing taxation when that money becomes, or those assets become, a legacy. So here we come to the end of the presentation. I would love for you to take this seriously enough so that you reach out and we connect so that I can offer you that guidance that you need. Again, my services are free of charge. I don't charge any money for meeting with you. There's no cost of a session. There's no cost per hour. We simply sit down, take a look at where you are, and then decide on where you want to be. And then I plan and help you to get there. It's been great. I love sharing with you, and I hope we get to meet very, very soon. Take good care.